Today I'm going to share with you the secrets the rich use to transfer income, assets, and their overall wealth tax-free. Because, okay, here's the truth. 70% of family assets are lost from one generation to the next simply because their heirs are not financially literate on family matters. 70%. But look, if you pay close attention to the secrets and the strategies in this video, then guess what? You can learn how to pass on wealth to your spouse, your siblings, your children, and so on tax-free. Because these wealth transfer strategies are available to anyone. It's just that the rich and the wealthy tend to be the ones that can afford to pay and learn how to take advantage of the system until now. So in this video, what I want to do is help people understand the tax treatment of transferring assets, the strategies that anyone can use to do this tax-free, and some tips to help you get started. So if all that sounds good to you, then all I ever ask is for you to hit the like button for the YouTube algorithm. That way other people like you can find this video and learn how to transfer wealth tax-free. Stay tuned. Hey there, and if you're new, welcome to the channel. I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. As always, what I'm going to do is put the timestamps for this video somewhere down in the description below. That way you can skip to the parts that you want to learn the most about. But I have structured this video in a way where in the first half, we're gonna look at how to transfer assets. In the second half, we're gonna look at how to transfer income. All right, let's dive in with a quick explanation of the tax treatment when transferring assets. So when you know your taxes well, you can understand how to completely avoid estate taxes. Otherwise, your nest egg could be taxed as high as 40% at the federal level and then more at the state level. So for the most part, there are three types of taxes that can occur when you are transferring assets. Number one, you have a gift tax. This tax can trigger when you are gifting an asset, which could be money or property, to a beneficiary without expecting something of at least equal value in return. Now, to be clear, the beneficiary or the person receiving the gift does not need to pay taxes, but the person who is giving the gift does. Now, in general, the federal government has gift taxes and most states do not. The second type of tax that can happen when you are transferring assets is number two, an estate tax. Now, when you hear the word estate, that pretty much sums up all the money and all the property that is owned by a particular person. So an estate tax is where a person's estate will pay a federal tax upon their death, not the beneficiary of the estate. The next common tax is number three, an inheritance tax. This is a tax the beneficiary would pay upon receiving an estate. So basically, gift taxes occur when you are alive and estate taxes are paid by the estate before distributions are made to the beneficiaries, and then inheritance taxes are the opposite. Those are taxes paid by the beneficiaries after distributions are received. Okay, let's go ahead and talk about how you can easily avoid these taxes, starting with number one, the annual gift tax exemption. So gift tax rates can range from 18 to 40%, but thankfully there is an exemption. In 2022, an individual can gift up to $16,000 per recipient per year without paying any gift taxes to as many recipients as they want to. So for example, if you have two children, you can give them $16,000 every year without incurring any taxes. And your spouse could do the exact same thing, combining for an annual $32,000 gift per child tax-free. But the gift doesn't just have to go to a child, right? You can give gifts to your parents, your siblings, your friends, or whoever you want to tax-free. So then what exactly qualifies as a gift? Pretty much any asset with value, right? Whether it's cash, property, stocks, and so on. But here's a quick tip. If you gift assets that have appreciated in value, like stocks, then you can do two things. Number one, you can avoid paying some capital gains taxes on the appreciation of those assets. And then number two, you can reduce how large your estate will be when you eventually pass, which is great. Okay, so what happens if you gift more than the annual limit of $16,000? Well, you can still avoid taxes with number 2, the lifetime gift and estate tax exemption. So any amount over the annual gift tax exemption immediately goes toward your lifetime gift and estate tax exemption. For people who pass away in 2022, the estate and lifetime gift tax exemption is $12.06 million. For example, let's say a parent gives their child $100,000. Well, that parent would have no tax to pay on that cash gift, and the child would have no tax to pay upon receiving that gift, as long as that parent filed a gift tax return showing the gift of $84,000 to the child, which is the amount after the annual exemption for the IRS to have on records. Thus, this would reduce the parent's lifetime exemption from $12.06 million to $11,976,000. So the exclusions that the IRS allows on gift and estate taxes are really high. And so these taxes are typically things that only the rich and wealthy need to worry about. But hey, I want you to keep your eye on the calendar, because in 2026, the lifetime exclusion will revert back to the pre-2018 levels and be around $5 million per individual. All right, another way to pass down generational wealth is with number 3, direct payments for medical and educational expenses. When you pay for someone's medical and education expenses directly, like the money goes straight to the provider, maybe that is a hospital or a college, then there is no limit to how much you can cover for them, because payments made directly to the provider do not count as a gift. This is likely why some billionaires have elected to pay for college students' tuitions directly as opposed to writing the students a check. Now, this shouldn't be confused with contributing to a college 529 plan, because that plan technically does count as a gift. So then why even use a 529 plan? That's something that we talk about as a strategy all the time. Well, the point of that plan is that your contributions can grow over the years and be withdrawn tax-free, unlike direct payments where you would be using your after-tax cash to pay for expenses directly. Okay, so basically, if you pay the provider directly, then you can escape some estate and gift taxes. Now let's look at some ways to transfer income with number 4, hire your kids. So if you are self-employed or you own a business, then hiring your kids is an amazing way to not only transfer income to your kids, but it also gives your business a great tax deduction. And it's easy, okay? You get a tax deduction for paying your kids, and in turn, your kids or you can use that income tax-free to help provide for what they need. However, it is only tax-free if you pay them under the standard deduction. So for 2022, the standard deduction is $12,550. And what makes this number very important is that when you hire your kids, if you pay them less than $12,550, they are not required to file or pay taxes on their income. And that's an incredible tax and wealth hack, right? Like, we all know kids cost money, and what most people do is they make income, then they pay taxes, and then they pay or provide for their kids. Well, when you hire your kids, you can flip that. Okay, you can pay your kids, then reduce your taxes, and then make more money after tax. And here's another bonus. LLCs are required to pay Social Security and Medicare taxes, also known as FICA taxes, for each W-2 employee. But since you're hiring a child as an employee, that also is not required. According to the IRS, payments for services of a child under the age of 18 who works for his or her parent in a trade or business are not subject to Social Security and Medicare taxes if the trade or business is a sole proprietorship or a partnership in which each partner is a parent of the child. You can also hire your kids through various means, such as starting a family management company for your businesses. And look, this is why I am such a big advocate of entrepreneurship, because not only can you make a higher income, but you can take advantage of the perks within the tax system. Which, by the way, I have a great video where I break down business ideas that almost never fail. So I'll link that video at the end so you can watch that right after you finish this one. Okay, moving on to strategy number 5, I have the Roth IRA. Roth IRAs are very powerful tax advantage retirement accounts where the assets within the account can grow and be distributed tax-free. Now, there are two reasons why this is great for transferring income. Number one, you can make your spouse, your kids, your grandkids, and others beneficiaries of your Roth IRA, and therefore they can withdraw from that account tax-free. So that's easy. Okay, number two, if you do hire your kids and they make earned income, then you can also open up a custodial Roth IRA for them. Okay, this allows your child to contribute their earned income into their own Roth IRA every year up to the annual $6,000 contribution limit. But $6,000 for a child may be nearly all of their income. But here's another hack. Okay, as the owner of the custodial account, you can match your child's contributions to the IRA. So the child can contribute $3,000 and you can contribute another $3,000 as an annual gift. And at a very young age, you can start teaching your child very important financial lessons about managing money and long-term investing and compounding interest. Okay, let's keep transferring wealth with number 6, loans to family members. Each month, the IRS establishes special interest rates known as applicable federal rates, which can be used for intra-family loans. These are typically far below other commercial lending rates, so it can be an effective strategy to help family members maybe buy a home or start a business or make some other large type of investment without having to go out and get a high interest loan. So although you aren't really transferring income or assets, using an intra-family loan can help your family to use leverage as a means to build their own wealth, especially in today's environment where interest rates are rapidly growing. Okay, moving on to strategy number 7, I have irrevocable trusts. So by transferring your wealth to an irrevocable trust, the assets can be distributed to the beneficiaries tax-free. But here's the thing, okay? Irrevocable trusts have some very harsh rules. Essentially, you lose all ownership of your assets the second you transfer them into the trust. Plus, once the trust has been set up, it cannot be changed or canceled after the document has been signed. So it's kind of like a marriage where, except in this case, divorce is literally not an option. So whoever the beneficiary of the irrevocable trust is, even if they curse you out, even if they become a drug addict, will still be the beneficiary of that trust. That's why many people prefer to establish a revocable trust fund, but unfortunately, they don't share in the same tax advantages. Anyway, for most people, it doesn't make sense to use irrevocable trust unless you are certain you will exceed the lifetime gift and estate tax exemption of $12.06 million today and about $5 million in the next few years. Now, since you made it this far in the video, I have one bonus tip for you on highly appreciated assets. So if you have a highly appreciated asset like a piece of real estate, it is typically better to pass it down through your estate than as a gift while you are alive, because when estate assets are distributed to its beneficiaries, they receive what is called a step up in cost basis, which basically means that when your beneficiaries receive that asset, the cost basis will be adjusted to today's market value. So for example, if you bought a piece of real estate valued at $100,000 and then it appreciated to $1 million by the time you died, well, your beneficiary will receive a step up in cost basis of $1 million, thus would not have to pay capital gains taxes on your $900,000 profit. All right, now here's some very important notes to remember. Right now, the Biden administration is proposing changes to the tax code, which include reducing the lifetime estate and exemptions down to $3.5 million, which again, today is at $12.06 million. They are also discussing completely eliminating the step up in cost basis and increasing the highest estate tax rate from 40% to 45%. Now, of course, these things are just proposed and it's left to be seen whether or not these changes actually go through. But it's still something just to keep in mind while you are planning and voting. All right, let me know if you enjoyed this video. Coming up next, I have 2 other videos I mentioned I would link at the end, so make sure you check those out if you haven't already, and I'll see you over there.